Hey, good day, everybody. And a good morning and a good afternoon now, right? Yes. So in front of me, this guy is our star speaker. Don't go anywhere. So Tony Abate, Ross Mortgage. One of the things that we hit recently was to simply go, hey, there's this thing called recasting. And what we know is most real estate agents, surprisingly enough, have never heard of the term. So thus, today's hot topic, we know that we got up to 30 minutes. You guys are going to have plenty of time to be able to ask questions of Tony, but he's got a presentation. I'm going to have him share his screen and away we'll go. So Tony Abate.
Thank you, Darwin. Let me do a screen share here. So
There you go.
okay. All right. Okay, everybody can see the mortgage recast screen, I hope. And like Darwin said, I'm Tony Abate. I'm with Ross Mortgage. And this almost sounds like one of those topics of secrets that the lenders don't want you to know. And it's not that at all. But recast is not something that you're going to see on a billboard or see an advertisement. It doesn't come up in closings. But especially in this market, it is definitely a relevant topic because it can change the strategy that a buyer might use to purchase a home. So we'll start at the beginning. What is a mortgage recast? So a mortgage recast is the recalculation of a mortgage loan's principal and interest payment based on a lump sum adjustment to the loan balance after the loan closes. So that it's a recalculation. It's nothing more. So let's see what the screen to advance. There we go. So some notes to know on this. Almost all mortgage servicers will permit a recast. It's not going to advance with my mouse, is it?
You may have to do it once.
See, it's
Down here. Oh, you're probably sharing.
because it's the full screen.
Yeah, you're
That's
doing
okay.
the
We'll
share.
just do enter. Okay.
There you go.
So almost all mortgage servicers will permit a recast, but it's not spelled out in the mortgage note. It's done as a courtesy by the loan servicer. So the option to recast it's not guaranteed. And so when we're talking about this with consumers, we want to make sure and set that expectation properly, that it's not a right that is burned into the mortgage note that a home buyer has. But I would tell you that Ross Mortgage, we sell to about 12 or 14 different servicers. They all permit recast. They all always have. And so you're definitely going to see that there's more servicers that permit that than don't by a long shot. But we do know that when we close a loan and transfer that servicing to another servicer, they do permit that loan recast. There is typically a fee. You can kind of look at this as almost like a cheapo refinance. A person is getting a new payment based on a lower balance, but their interest rate stays the same. There's administrative work that has to happen to make this work. And so that's why servicers are usually going to charge a modest fee. Like I said, $250 to $400 seems to be the norm for that sort of a thing. In some cases, there's a minimum, but it's a makes sense minimum. So in other words, if a servicer is going to permit the recasting of a loan, they don't want that home buyer to put $400 on the mortgage and then ask for the payment to be recalculated. They're going to say, look, get us at least $10,000 and then we'll recalculate that loan payment based on the new lower balance. Okay. Sure, Brenda.
Is this recalculation only done on the sell or transfer from one lender to another?
Yeah, and I was going to
No,
say,
like
actually, there's a couple questions. Well, one important one there. How is it different than a refi?
Sure. So a refinance is a brand new loan. And Brenda, we're gonna come to that. That's a good question. A refinance is a brand new loan. So not only will the consumer have the bucket of closing costs that come with the refinance, they're going to get a new rate because it is a brand new loan. Now, in some cases, it may make more sense for that consumer to refinance. If they're sitting at 4% and they can refinance to 3.5%, then great, do the refinance instead of the recast, and you can accomplish the same thing. When we're in a market like we're in right now, where rates are trending upward, that consumer is going to want to hold on to that interest rate that they have and get the best of both worlds, right? They want the lower interest rate, but then they want that payment recalculated as well. So Brenda's question, Brenda, if you could
I
state
was
again.
asking if this mortgage recast only comes in effect when the current lender
Mhm.
sells that loan to another lender.
Sure.
Is that when that recast occurs, or?
So Brenda's question is when does the door open for the recast? Might be another way to say it. Is it only available when the loan is transferred to the new servicer? And the answer is no. It's really available at any point in time during the duration of the lifespan of the loan. Okay, so we're going to be talking in context of somebody doing this, maybe just a few months after they close on their purchase mortgage, but a person could be 10 years into their mortgage. And maybe they received an inheritance or they sold some other asset and they have a lump sum of money and they wanted to use that to cast down their mortgage, they can do it at a later date as well.
Okay, so
Yeah.
it's similar to a refi, just you maintain the servicer, you don't have to pay the closing costs, but you will pay a fee of $250.
Correct.
For the service itself.
Right. And you maintain, you keep the interest rate. Nothing changes with the interest rate. So unlike a refinance where it's
Yeah,
completely restarted, a new mortgage is, old mortgage is discharged, new mortgage is recorded. In this case, the mortgage stays in place. It's just new mathematics behind it all. Okay.
Why is you have money, additional money, you want to reduce your principal and thereby.
Correct. And we're going to get into an example for that because it's really super relevant in the market that we're in right now. Okay. So how can this benefit a home buyer? Again, we're talking about something that might seem like a dry and mundane topic. It's basically an accounting procedure that happens behind the scenes. How in the world is that even relevant now? Well, there's a few things. Number one, it can help a purchaser make an offer that is not contingent upon the sale of their home, where they would otherwise have to do so. We'll talk about how that works. You can give the option to a buyer to make a more robust appraisal guarantee. I mean, that's the cool watchword of the day, right? Is making offers where there's an appraisal guarantee. Well, there needs to be some asset conversation around that will help whether to determine that's feasible or not. So if maybe somebody takes a larger mortgage at the beginning, or in the background, they've got an appraisal guarantee, 20,000, 30,000, 40,000, whatever. If they end up closing on the transaction, end up not needing that appraisal guarantee, they could use those monies and chunk down that mortgage balance at a later time and kind of get back to where they wanted to be from the get-go, which is a mortgage of a certain size. And we kind of alluded to this. This permits the buyer to right-size their house payment after their current home sells. Because again, you can see what's happening here in this market. Somebody writes a non-contingent offer. They win the horse race. They can close on that new home. They pushed out all the other buyers. But now after the fact, what happens? They sell their prior home. Now they've got all those proceeds that they had intended to put towards that new purchase. But things happened out of order. Right? So the recast allows them to kind of get back to the goal that they wanted to have accomplished, which is a mortgage size that is commensurate with the sale proceeds that they had on that prior home. Okay. So let's look at a scenario. So a home buyer wants to purchase a home and we're just going to say it's $400,000. If the offer is contingent, which is kind of the baseline of the standard, they'll have enough proceeds from their sale in our scenario where they can make a 25% down payment. In doing so, 25% down on a $400,000 purchase means that their mortgage would be $300,000. If the offer is not contingent, what happens? Now this home buyer does not have access to the equity in that current home, so they look to their other resources. What's in my savings account? Maybe can I borrow against my 401k? Maybe mom and dad can help temporarily. These are some things that can sometimes be assembled together to keep that transaction alive. But what usually doesn't happen, they usually can't assemble enough assets to duplicate that 25% down payment. That's a pretty robust chunk of money. But maybe they can do 5% down, okay? And in accepting the offer, not contingent, 5% down, Now that consumer's mortgage is 380,000 instead of 300,000. So what's the good news and the bad news? They got the home they wanted. That's the good news. The bad news, their mortgage is $80,000 higher than what they wanted it to be coming out of the gate. Okay, so how does it all work? So buyer makes that non-contingent offer for 400,000, which is accepted. That's what the sellers want. Don't bother me with any contingencies, right? The buyer's mortgage of $380,000, because again, they put 5% down. They don't have the proceeds from that sale. $380,000 mortgage has a principal and interest payment of $2,125, and they have PMI, right? Because it's less than 20% down, of $105 per month. So the total payment, not including taxes and insurance, because that's going to be the same no matter what happens, total payment of $2,230. Okay, so they got the home. They didn't want PMI, but they have it. They didn't want a house payment as big as it is, but they got it. But they did accomplish their goal. They got the home. Now, after the fact, they sell their existing home. They close. They get the proceeds, and they've got that $100,000 in equity out that they had preferred to have happened first, but it happened second, and that's okay. So now they've got it. They own the new home. They've got $100,000 cash in hand from the proceeds that they did not use towards the down payment. But they can take 80,000 of that, or 100. They can do whatever they want, any dollar amount they want. But in our scenario, they can take $80,000 of those sale proceeds, go back to their servicer on their already closed loan, and say, "Hey, servicer, I want to chunk down this balance. Here's my cashier's check for $80,000. Recalculate my payment based on the fact that my mortgage is now a $300,000 balance instead of a $380,000 balance." So their payment goes down to $1,681, and because they expanded their equity position, not through appreciation, but by absolutely chunking down that mortgage, that PMI does come off the mortgage at that point in time. So that $2,230 payment, maybe they have to make it for a month, maybe two, maybe not at all. But then they're, using the recast, they can get back down to that $1,681 payment, which was the original plan, had they been able to sell their existing home first. Okay, so this is having the cake and eat it too, without a doubt. It's kind of a cool thing. And like I said, this is not on any billboards. It doesn't come up at the closing. It's not embedded in the terms of the note, but every servicer that I'm aware of makes this option available for consumers. So when you have that apprehension from the potential buyer and saying, you know what, I would buy this home, but I'm a 20% down guy. And I'm not buying it because I need to. I'm buying it because I want to. But if I can't do it with that nice, robust down payment, I'm going to be out. I'm not going to go forward. Well, now you've got a reasonable response to that objection that says, well, here's how we can get there, even if the steps are a little bit out of order. And a sale happens because of it. So one caveat to that idea, obviously, if they buy the new home before selling the old home, they got to qualify with both. But, many times that happens. Many times that happens. So this is a way to keep a transaction together that on the surface would have to be written with the contingency, since for most of us, that's where the bulk of our assets are. Okay? Now, a person can take those proceeds, chunk them down on their mortgage balance, and not recast the mortgage if they didn't want to. Okay, I think they really would in our scenario. Why would they pay the PMI if they don't have to? But maybe it's a different set of numbers and they already have 20% equity. They don't have PMI. Why would they want to do that and not recast the mortgage? Well, the reason for that would be now every house payment mathematically becomes an overpayment. The payment has gone down, but they're going to pay off that mortgage much more quickly. Okay, ball is completely in the consumer's court. They can do it when they want to do it, how much they want to do it within reason, and how with the desired outcome. Do they want to reduce the payment or do they want to shrink the term of the mortgage? Okay, so I always like to talk about these things in context of a reason to call somebody who's a prospect, reason to call. And not the old cliche, hey, do you know anybody who wants to buy or sell a house? And now it's, hey, I know we talked before, you need your equity out. Let's talk about a plan that might work for you. So it's a great reason to call. You're a solution provider, and it gets you one step closer to a transaction and mission accomplished. Okay, Brenda, you got a question?
I do. Concerning the PMI, once you get 20% equity in your home, the PMI comes out daily, correct?
That is correct.
And
Uh-huh.
it's usually up to the homeowner to notify the lender that it needs to be removed as opposed to the lender advising them.
Yeah.
So, okay.
So, okay, go ahead. So what was the question? Yeah.
So, I just lost my train.
That's okay. So how does the PMI come off? Is that,
No, I know it's supposed to come off with 20% equity or something regarding this last statement here
Okay.
on the screen.
okay,
If they just want
Because
to
you
remove
just-
the PMI, they can do that and still keep that payment at the 2230 as you indicated. The additional funds will just be paying that principal.
that's a good point. Yeah, that's a third option. Take that lump sum, chunk down the mortgage, remove the PMI, but not recast the payment. That absolutely would work. Yeah. Mhm.
Or they wouldn't have to put that extra money down. They could just ask for the PMI to be removed and continue to pay the 2230 without being recast.
Well, yes, but they would have to put down enough to get to that 20% equity point.
Okay. got it.
So,
That's true.
but point being is that there's options.
Yeah.
Yeah. Mhm. Were there other questions in the chat?
Well, that's what we're gonna find out. So
Okay.
gang, if you want, this is gonna be a little bit different from what we've done previously. So if you want to take yourself off, we've got, it's 12:17.
Mhm.
So I knew this would be a little bit shorter subject, but if you guys got questions, go ahead, take yourself off mute and let's throw them out there because I know there's got to be something.
Mhm.
Somebody's got something.
I know it's such a hot and sexy topic.
Yeah.
And people
I
can
had a
talk.
question. If your buyer decided to do this, would you make sure that the server would do this for them, that it's part of it? Because you said most of them do it, but not all.
Right. That's a great question. So we do need to be careful with how we talk about this with consumers. Thank you, by the way, Shelley. And we want to put it out there is that this is an option that you can do, because here's what we can't stop or control. Just about every mortgage that's closed has the option, the servicer has the option to transfer the servicing yet again. Okay, so we don't know if a mortgage is going to go from a servicer who will permit the recast to a servicer that will not. I will tell you, I'm not aware of any that don't, but again, since it's not embedded in the terms of the note, that could change. That really could change. So we can do it, Shelley, to the extent that we can. I mean, we can target a particular servicer. We can confirm with that servicer that they'll permit the recast. But if the consumer basically just waits a year, 2 years, whatever, for any of a number of reasons to do that recast, if the loan is transferred again, we can't assure that the downline servicer would permit that. So I've never seen one turned down. I've never seen a curveball thrown at a consumer. But again, we want to be judicious with the dialogue in that this is something that most servicer permit, but the consumer can't sue the servicer if they choose not to permit the recast.
No, my
Okay, so
understanding in front, my understanding is that you can do this one time
Mhm.
in the life of the loan. Is that something you're aware of? Am I?
Most servicers, that's a great question. So most servicers will permit a one-time pay down, but if that loan is then transferred to another servicer, there's nothing that would dissuade that next servicer from doing it.
Okay.
But yeah, it creates some accounting turbulence, and so they don't want to keep doing this over and over again.
Right.
So the closing advice on that is, while that consumer has that bucket of money, think about it. What's the best use of that money? It might be chunking it down on the mortgage, but use that as an opportunity to look at other things going on in their financial world.
Yeah, it's really stands to the point of, do you want to reduce the payment while retaining the interest rate?
Yes. Mhm. Yeah, exactly.
Okay.
Exactly. Yeah,
All right.
Yeah.
And then a question in the chat, it says the recast reduces the payment, but just the lump sum payment.
I think I see where you're going. I think you might be looking at it from almost like a mirror image. So it's straight math. When the loan starts, it's a principal and interest payment that is based on, in our example, a $380,000 mortgage at a certain rate at a certain term. Okay. The recast says Now a lump sum has been applied to that mortgage. The new payment is based on whatever the new loan balance is. So it, of course, is tied to the recast amount, but the new payment isn't based on, it's not calculated off the recast amount. It's calculated off what the new loan balance is. I hope I answered that.
I think so. If I tried to add to it to put clarification, it's like we just changed the down payment. All other terms remain the same, but we put more money down, and now we're going to leave all things the same, but recalculate a payment, staying with the remainder of the term, the remainder of the loan, and basing the payment on that new balance with the term remaining. So the big benefit to somebody is that if they want a lower payment after receiving this lump sum, and as a matter of fact, one of the things to remember, because again, very few agents realize this, and I'd never heard a mortgage person actually talk to a consumer about it. You've got contacts out there that are going to say, yeah, we came in, or we just got, mom, dad passed, I got a lump sum of money. That would be something that just from a point of servicing and being able to elevate your knowledge, and you mentioned it, it's another reason to call, but your knowledge of recasting is a service to the people that you know. So when people bring the subject up, you may want to say, well, hey, have you ever thought about recasting your loan? And they go,
What? Yeah. It's just a way to elevate yourself over the competition.
Yeah,
Really.
yeah.
You become the go-to answer person.
absolutely,
Yeah.
absolutely. So I don't see any other questions in the chat room. Nope, I got that one. Oh, it says 3 new ones. It didn't show. Thank you. Where would it be written?
See,
Can you
that's
use
just
any
it.
amount? Excuse me, I have a
okay,
question.
We'll come back to these. Holly, go ahead.
Can you put down any amount like 15%, 25%, 30% down to recast?
You can within reason. Servicers don't want to do it for minuscule amounts of money. The lowest that I've seen is $10,000. Some don't have a limit. If you want to recast with only 5,000, they'll let you do it. But it's kind of anticlimactic for the consumer too, because there's not much change.
Yeah, because 5,000 is going to change the
It's not
payment
going
much.
to, yeah, it's probably not worth the $250
Yeah,
to
at that point, it's just
Yeah.
knock the balance down and pay it off earlier.
So yeah, there's not a percentage threshold or requirement. It's hey, servicer, I've got this bucket of money. I want to apply it to my mortgage. Let's recalculate the payment based on that new balance.
So there is a couple of questions in the chat room here. So it says, where would it be written in the mortgage itself?
Yeah, that's an important thing. And the truth is it's not. It's not. Like I said, it's this is done as a courtesy and as a service by the servicer. And this is one of those things, in real estate, we kind of deal with common practices and trends and things that are typical. This is one of those things. It's typical for a servicer to permit that recast, but if they wake up tomorrow and say, hey, we're just not going to do it for whatever reason, it's not like they are in breach of their side of the note. So again, we have to frame that conversation properly with the consumer. We can't say, this is absolutely what you can do. You can say, this is a strategy that you can talk about with your servicer after you close. Again, between all us kids in the room here, I've never heard of a servicer not doing it, but it's not a function of the mortgage note that says that the servicer has to do it.
Next question we have in Lapeer is, does it affect your credit score?
It absolutely should not, because you're already in the loan. There's no new approval process. This is more of an accounting procedure that takes place. So I've not heard of any reason why a servicer would run your credit. In fact, I would argue that they can't, because it's not a request for new credit. And credit reports, there's a limited number of reasons why a creditor has the right to run your credit report. I would say this falls out of that bucket. And second to that point, I would say that reducing the principal balance really wouldn't have any impact on a person's credit score.
Excellent. And Nancy says the length of appraisal time frame versus recasting. So Nancy, I think
markets go
you're
down.
referring to potentially refi versus doing a recast.
No, I meant how long are they going to, we all know that the market's up. So let's say it's 5 years from now, 2 years from now, and the market takes a dip. Are they still gonna go by that old appraisal if it's a couple years from now, is what you're saying? That's what I'm hearing, but I wanted to clarify.
Sure. I'm going to say that that's probably not a relevant factor in the recast. Even if the market dips, if that consumer chunks down their mortgage balance, the risk level to that servicer has now gone down. So
As
this
far
is
as
a
the
different.
PMI?
I was gonna say, Nancy, are you referring to the PMI?
Yes, yes.
Well, okay, so you got a couple of regulatory things in play. There is a compliance piece that says a servicer is compelled to remove the PMI when the consumer pays down that mortgage balance to 20% of the equity from when they started. Okay, so if you just chunk down that balance, that servicer is compelled to remove that PMI at that time. Okay, this is different than somebody saying, hey, I've been making my payments. I believe I now have 20% equity. I want to get out of my PMI. Then the servicer is going to typically require an appraisal to confirm that. So, but when it comes to the recast, it's really more of an accounting procedure from a payment calculation standpoint. And again, I would submit that the risk level to the servicer is it's doing nothing but going down regardless of what's going on in the market. They've already got the loan. I mean, they're stuck with it, whether it's a great market or a poor market. So if their risk is reduced, their life only becomes better. So they really wouldn't have a compelling reason to not do the recast. Good question, though.
So we've got a couple minutes left. If anybody else has got a question,
Over here.
we got one inside here, Troy.
Can you talk about the first responder loans?
So the first responder loan is something that is not available through all lenders. We actually don't have it right now, but it's like a variation of a first-time home buyer loan. So what it's going to do is that it's going to provide some enhanced terms and benefits to the first responder, maybe lower down payment, lower cost PMI in exchange. I'm sorry?
I heard they were waiving.
So a first responder loan is something that's going to be lender specific. So they certainly could provide a program that is going to have no PMI for that first responder. It seems to be a program that kind of ebbs and flows in and out of the market. Again, we're not offering at this point. So I can really only talk from a high level of what they typically are. But from my experience, what I've seen is that it typically takes a lot of the benefits that are embedded in the first-time home buyer loan program and offers it to the first responders. Yeah.
And with that, I'm showing 12:29. So unless if there's a quick thought, we're going to wrap things up with that. Anyone here, anyone out there? I don't see any other questions. So recasting. Hold on to that thought as you're out and about doing your business. Talk to folks. Tony Abate, do you want to throw a phone number out real quick on how they would get to you?
Sure. They can reach me at 248-821-5411 or rossmortgage.com to get to us and any of the loan officers within the company.
So gang, I hope you enjoyed this one. Find it informative, and we're going to run it from there, and we will see you next week for another Hot Topic Tuesday. Everybody have a great one.
Bye,
We'll
everyone.
see you.